Okay, so now we're going to talk about risk management. So this is an important thing. Um, there's a bunch of different models out there for how people manage their risk. They manage their risk by the trade. They manage their risk according to their overall trading account. Um, I'm going to start by saying just kind of a blanket statement that is kind of widely known in the industry. The industry recommendation is that on any one trading opportunity, you don't risk more than 1 to 2% of your account is what they recommend. Um, this is fine. The problem with that is that in order to keep that guideline, you're trading pretty small. So those of you with a small account, you're going to be trading, you know, really small positions in order to stay in those guidelines. And that's fine. That's fine for learning. If you're just getting started, you're just trying to get your feet wet. That's fine to stay in those guidelines because you just want to understand what you're doing. That's more important um, to build the skill set. Um, Once you know what you're doing, I think you could push that up a little bit more. I think you can go to 5 or 10%, depending on the trading opportunity. Um, you could risk 10% in order to maximize your gains on these trends that we're following. So, it comes down if you got a small account, if you got $1,000 trading account, don't lose more than $30 to $50 on a trade, because at the end of the day, you just want to stay in the game. If you bet too big and uh, and you have a few losers in a row, you're going to be wiped out, and then you're not going to be able to trade anymore, and that's not going to do anybody any favors. So, um, when you're first starting, start with a small account. In fact, start with a demo account when you're very first starting. Get your feet wet, learn how to trade, learn how to get in and out of trades, and then when you start with your real money, start small. Earn the right to raise your lot size to trade more money. Uh, give yourself deposit more money in your account based on your success. Do not leverage up when you're losing. So, pretty straightforward concepts. I'm not going to spend a lot of time on that. When it comes to monitoring your risk from a technical standpoint using our software, what you want to do uh, is that monitoring your risk kind of goes hand in hand with entering the market and watching an opportunity play out. Um, when you first enter the market, that's when your risk is going to be the most. But as the market goes in your favor, then you can start to tighten up your risk, and kind of work with the market accordingly to what the market is doing. Here's a trading example. For instance, at this point we were in this long market. You can see where our directional bias was definitely long. We got 4-hour candles just stacking. I mean, the thing's going through the roof. Okay. Right here you had a trade. We came out of the box here. Remember, boxes are no trade zones. We came out of the box, popped down, and then next thing you know, we got a white line and we're below, right? So you could have bought this turn right here, and this would have put you up a little bit here. This actually, was a good trade. Didn't take off. It didn't push the trend at all, but it was a good trade. You get bottom of the white line, it wrapped around. You're up. This is like you saw 18 pips on this trade, and then it came back through. So to monitor your risk for a profitable trade, a good rule of thumb is that when you remember in a buying market, you want to buy below the last white line. So you would have bought this, it would have popped up through the white line. Basically, here's the facts: is we're trying to catch an entry that's going to continue the trend. We want to continue the trend upward. Okay, so we're looking for that behavior to unfold from our trading entry on. Okay. So when you get up here and you see like, okay, it's breaking the high from back here, it's pushing, and the next thing you know, it starts kind of falling apart. We really don't want to go back below the white line because now we bought the market and now we're at another place where we would want to buy the market again, and that's not where you want to be with your trade. You want to buy the market here, you want to sell it above the white line. Okay. So if you're expecting that the market's really going to take off, you feel good about it, and it doesn't, don't go back below the white line. When you got candles that are clearly above and you've seen a profit, just cut your loss or take a small profit and let it reset. Let it come back down. And then your next opportunity would have been down here on this particular trade. You would have bought on this turn here. And initially, when you would have bought these, when you buy these turns, a good rule of thumb is when you see blue on that 15, just stick your stop loss somewhere by the active low. When we say active low, it's like the nearest low to where you're getting in, and this would be reversed if you're shorting the market, if you're selling. So same concept, just in reverse. So right here, you would have bought the market. Your stop loss would have been down in this neighborhood. Okay, you're seeing some profit on this, and then look at what happens. Oh, look at it's not wanting to break through the expansion. It's not wanting to. See? So you're hitting that. You're hitting that like a ceiling. And what does that tell you? Psychologically, that's for what we're doing, that you should be thinking at this point that if this behavior is correct, if the market makers are really really accumulating buy positions for their overall book of business to make money on, then we should be getting back up through the white line. You should be looking to break this high and go, but it doesn't happen. And this is going to happen every once in a while. You're going to have to know how to navigate out of this. So it's pushing up. You see a turn. That's kind of your first, like, okay, what's going on? And then you get an aggressive push down. Okay, at this point, if you see that it's holding that price level and you're expecting the trend to continue and it's not, this is where you want to dump that trade. You want to get out and you want to let the market reset. And in this case, so you're closing your trade. Let's say you got in here, right here on this candle. You're going to close it right here on this candle. You're probably taking a small loss. You're probably taking like a 5, maybe a 10 pip loss if you held on a long time. Okay? As that drops, you're looking for another reset. When it gets down this far, I'm not going to trade. I'm not looking that I'm going to get a stack of 15-minute candles all the way back up to this white line. So I'm going to leave this alone. I'm going to wait till we get a new white line. And in this situation, we're probably pulling the 4-hour short. So let's look at that right here. This is let's see, 11:30 candle. Okay, so yeah, that would have been right here on this turn down. And you can see when you're coming out of this, it started blue, but it pulled short. And next thing you know, we had a big dip on the 4-hour. So this would have taken you out of criteria anyway to trade. So you'd be dumping that trade going short or going long. You would have dumped it, and you wouldn't be touching any of this. Why would you not be trying to sell this? Because you're against the last white line on the 4-hour. So you would have picked it up right back here where you confirm blue on this 4-hour candle. And here you go. Here comes your trades again. So you would have taken that small loss right here when you saw it wasn't going to break through the expansion. That's a telltale sign right there that it's not behaving the way it should. And you get back below where you entered. You don't want to lose money on this. Boom, it blasts down. Let it reset. Here comes the next trades right here. This is, let's see here, your first trade, 23.05. Okay, that's right here. Inside this candle, you can see you already had a blue confirm candle here on the 4-hour. You're in criteria because you're above the white expansion. And there's your next candle right there. And boom, here it starts again. There's your first trade. Get below the box right here. You got a white line right here. Here's your turn. There's your second trade. Here's your third trade. Down below. It goes down. Here's the turn. You buy right here. Trying to get back up above that box. We had a box, and see, look at this right here. If you bought this one, you're below expansion right here. You got a blue candle over here, and look at what happened. You bought right here. It comes up, and it starts to turn. See, it looks like, because this hadn't happened yet, remember. So it looks like it's holding that average price. Right now, you're like, okay, I don't know what's going to happen. And you're in the money. Like if you would have bought down here, you're up pretty good. So, you've kind of bought and paid for a ticket to ride this trade out. If this had turned down again, then you don't want to go really back below where you got in. Anywhere below that, down in this neighborhood, you don't want to go. So you don't want to lose money, just wait for it to reset. But in this case, you got a new box and then boom, it exploded right out of the box and completed the original trade that you would have entered down here. So you bought that rotation, coming back through, trying to get to the other side of this white line originally. You form a box, and doesn't mean you got to get out of the trade because you're already trading from down here, but boom, it explodes and it pays you massively. So you took a little loss right here, and you got paid huge on this run. And remember, just because you're trading criteria. So these concepts are real basic. I know, I keep pounding that, pounding that through these lessons, but I just want you to get, if you get the basic concepts, then it's going to make your life a lot easier, and it's going to make the learning curve a lot easier. But so remember, your risk is going to kind of go hand in hand with how the trade is behaving and according to where you got in as well. So this one, you would have dumped it, and like I said, when you're initially entering under these white lines, you want to kind of, when you're first entering on that blue candle, this is the part that takes finesse. You want to keep your stop pretty tight, like to the active low. So if you entered here, you want to keep your stop down here. That's like, you're talking like a 10, 12 pip stop on this particular turn right here. So you want to kind of keep it in there. Once it starts going, then you're expecting it to break through that white line. Remember, you're in a long market, in a market that's going up. We're just taking it from the bottom of the white line through the top, bottom to top. And then when you're going down, we're taking it top to bottom, back and forth on that white line. So anyway, you would have dumped that trade when you got through here, and good so, because a lot of traders, they don't see this. They don't get this kind of accurate look into the market, and they're going to ride this down and get, a lot of, especially new traders, are going to get they're going to take a huge loss on this, and it's not necessary, because the content of the market, what's really going on, what the banks are doing, is very clear here. So and then you would have picked it back up here, and you would have got paid. You would have made anything you lost on that turn back, plus a multiple of it. So anyway, hopefully that helps with understanding how to monitor your risk. But remember, the overall key concept is to stay in the game. Don't risk so much on one opportunity that it's going to blow out a quarter or half or all of your account. It's stupid. It's a rookie mistake. Don't do it. All right? Trade smart. Trade in the trend. The trend tells you which way to go. ATS tells you where to enter. Just do what it says. You'll be fine.